Hello, everyone, and welcome back to the Value-Driven Ownership Program. Today, we will be taking a deeper dive into free cash flow, a sustainability factor. Part 3 of a 4-part series examining the key assessment factors involved in doing a valid feasibility analysis. Big picture? Free cash flow is the cash produced through normalized operations. We call it adjusted EBITDA, minus the cost of capital expenditures for infrastructure, often called CAPEX, and minus debt service or financing costs, usually called interest expense. It's a profitability report that helps us measure the ability to grow and increase value based upon the cash flowing through the business. That's why I love it and why it's commonly used to measure performance. I'm Debbie, a certified SBDC advisor at the Colorado Small Business Development Center under the SBA. I am also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. And I'm here today to help you understand this thing we call free cash flow. Capital expenditures are all about infrastructure, which refers to the basic systems, both physical and organizational, that support a company's operations. In some industries, infrastructure is simple, non-capital intensive, such as consultancy services, e-commerce, digital marketing, and website development. They require relatively little investment in physical assets. Thus, the cost of entry is low. In other industries, however, infrastructure is more complex, capital intensive, such as manufacturing, oil and gas, and computers. These businesses might require the purchase and maintenance of heavy equipment, large and expensive vehicles, computers, maybe a warehouse, a building, unique technology, patents, copyrights, or special work processes, and a whole lot more. The cost of entry and ongoing cash flow requirements is high, very high in some cases. In either case, some serious cash flow planning is required to ensure the infrastructure of the business is stable and secure. This means that cash must be available above and beyond a company's operating needs and the owner's needs for compensation. Let's talk about financing costs now. Financing costs relate to the capital structure of the business, ownership rights with cash flow requirements. This information can be found on the balance sheet, which includes debt owners and equity owner accounts. Collectively, the capital structure of a company. Debt owner accounts appear as liabilities and equity owner accounts appear as equity. Debt owners can either be secured, that is, they have preferential rights to assets, or unsecured. They have secondary rights. All of these debt owners are paid interest. Equity often has preferential classes that are all about voting rights and cash payouts. Generally speaking, preferred stock has an interest rate that is fixed and payable quarterly. assuming that cash is available. If not, the interest accrues, and this liability is paid first before any other equity owners are paid. Likewise, if the company is sold, preferred holders are paid first. Convertible bonds are similar. Any interest due is usually paid first. After that, however, they stand in line with common shareholders as the bonds usually convert into common stock. Common stockholders receive dividends, but these dividends do not accrue and they are not guaranteed. So, when we talk about debt service and we call it interest expense, we are really talking about interest due to debt owners, including preferred shareholders and convertible bond owners. We are also talking about possible dividends due to common shareholders. Remember, whatever the legal entity might be, there are almost always classes of ownership with preferential rights and debt service requirements. And this is what we mean when we talk about debt service. Let's take a look at a free cash flow calculation. It begins with adjusted EBITDA, or adjusted net operating income. Then we subtract debt service, the capital structure costs, and we subtract capital expenditures, CAPEX, or infrastructure costs. That's how the math works. Now, let's take a look at the numbers. Once again, it begins with adjusted EBITDA of $108,500 minus debt service, which includes bank loan interest of $7,500, preferred stock interest of $6,500, and common dividends of $1,500 for total debt service cost of $15,500. Then we subtract capital expenditures for kitchen equipment of $5,000 and computers of $3,000 for total CAPEX of $8,000. This results in free cash flow of $85,000. This is what I call discretionary cash. Cash available for growth, expansion, and to pay the owners. You need to monitor the sustainability of your business via cash flow. Make sure you are planning properly for CAPEX, the infrastructure costs, and debt service, the capital structure costs. You do this by analyzing sustainability using information in the free cash flow summary report that presents the 3 scenarios. Base, or the break-even case, is at 100%, the high case at plus 25, and the low case at minus 25. You look at the cash flow dynamics and the financing dynamics, and you ask yourself some serious questions. Let's do this for Robust Coffee, starting with cash flow dynamics. As you can see, cash flow is positive in all 3 cases. But is it enough? Will it grow? Next, consider the budget excess or shortfall. Notice the negative number in the low case of $15,858. Is it survivable? What happens if business drops off by more than 25%? How hard will you have to work? Take a look at the number of units per day that need to be sold in order to answer this question. Can you sell that many units? 86 per day in the base case? And now, some questions about financing dynamics using key performance indicators. First, the debt-equity ratio of 0.2. Debt of $75,000 divided by the $380,000 of owner investments made or equity. If you compare this to the industry ratio on a 3-year basis of 3.2, robust looks great. Next, the debt-equity ratio of 0.16. Debt of $75,000 divided by the assets purchased on the Startup tab of $455,000. If you compare this to the Starbucks ratio of 0.73, again, robust looks great. And finally, debt payback. Debt of $75,000 divided by free cash flow in the base case of $31,127 results in a 2.4-year payback period. Notice it takes almost 5 years on the low case. Can you comply with your debt requirements? Lots of good questions, right? So, with all of this great information, is the business sustainable? Maybe, if you're willing and able to do the work required to make this money, and you can pay back your debt on time. It's time for your homework assignment now, focused on evaluating the costs of infrastructure and capital structure. First, infrastructure costs. This can be found on the Cost Operating tab in the model down in Note 3. Include the cost of physical assets, such as equipment, and intangible assets, such as patents, something you cannot see or touch. Second, our capital structure costs. This can be found on the Cost Startup tab in the model. Complete the Uses of Funds table first, so you know how much money you need to launch. Then, complete the Sources of Funds table. This will help you understand how much money you might need to borrow or raise from outside investors. And third, answer the question, how do you know if your business is sustainable? Let's take a deeper dive one more time today into free cash flow and talk about why we need a report like this. You probably never heard of this statement before. It's certainly not in QuickBooks, and yet it's used by investment professionals all the time to buy and sell companies. Why? Why do they use it? Because, crazy as it may seem, information we need to assess sustainability does not readily present itself on an ordinary income statement or balance sheet. So, we need to take the income statement, make some adjustments, and do some thoughtful analysis. Think about our infrastructure and capital structure needs. Bottom line, we need to assess our cash flow performance in a meaningful way. Determine what kind of cash is left over from daily operations to fund growth expansion, and compensate owners. And that's what free cash flow is all about: the ability to fund growth, increase value, and earn a healthy return for investors on a sustainable basis. That means over the long haul. Next workshop, we will talk about return on investment and break even. So stay tuned, and I'll see you all soon.